Hey there, everyone. Welcome back. You are watching Insight. We are here with one of my favorite people, Heather Foster from Foster Financial Services, always bringing us some great information, great conversation. Heather, thanks for being back here.
Always good to be here.
Yeah, look, you are telling us today some tips and tricks on being able to get less taxes for our spouse. I like that right there.
Yeah, I mean,
everyone likes less taxes.
We want to take care of our spouses, right?
Yeah.
So this tip and trick is something that it's a planning strategy that we put together, and we do for people. And then it's also something that I just want to talk about that gets missed sometimes. So if you own a joint asset, let's say, well, in this experience, we'll talk about investments, right? You have a joint account in the stock market, and one of you passes away. You would assume, and there is a 50% step-up cost basis. So let's just say again that joint account, we'll just give an illustration, was worth $50,000 when you bought into it, but now it's worth $100,000. So it's doubled in value. Right. And your spouse passes away, your cost basis gets to step up on half of the money. So $75,000 is your new cost basis. So you'd only pay taxes if you cash the whole thing out on $25,000. Okay. But that is not something that we've realized a lot of custodians do automatically. It takes your advisor contacting the custodian and telling them, hey, this was a joint account. One of them has passed away. We want to adjust the cost basis on all the positions and step up the basis for half of the positions, basically. The tip and trick part of this, though, is and this is not a fun conversation. I'm just going to say that outright. Okay, when you're talking about this tip and trick, this is somebody passing away. So the process here is you actually would transfer all of the assets into one spouse's name. It's the spouse that is terminal, let's say, in this scenario. And if they've held it for 1 year in their name alone, they'll get 100% stepped up cost basis. Okay. So instead of half of the money only getting a stepped up cost basis and avoiding capital gains, the entire account can avoid capital gains altogether. Therefore, their spouse would inherit now that account completely tax-free. So, and it's not just investment accounts. So think about like a lake cottage. You have a primary residence, and most people don't have to pay capital gains tax if they were to sell their primary residence unless the gain on it's more than $500,000. So there's an exemption there that you get the first $500,000 of a gain on your primary resident tax-free. But if you have more than that, there's taxes. But if you have a secondary property, there is no such thing as a free $500,000 gain. You have to pay taxes on any gain. So again, let's just talk about a married couple. They own it together. The lake house, maybe they bought it for $100,000. They got lucky back when prices were very reasonable. Yeah. That same lake house is now worth $600,000. There's a $500,000 capital gain. Wow. If somebody needs to sell that house, they're going to pay a lot of taxes on all of that gain in that house. However, again, same scenario. You've got a husband and wife, maybe one's supposed to outlive the other due to health reasons. You can transfer that title over to one person's name. If they held it for a year, you're going to get that stepped up cost basis. So now the other spouse, when that person passes away, they can now sell that property and pay no capital gains because they inherited it and it was a transfer to them, and with 100% cost basis step up. So the conversation is here. Number one, make sure if you've been widowed already, even go back and make sure your cost basis on any joint assets was stepped up. Okay. It is something you have to sometimes take into your own hands and make sure those custodians, which is like, Schwab, Fidelity, the custodian where your money physically sits actually did, in fact, step up your cost basis. And then if you do have a scenario where someone is maybe either a lot older than the other spouse, which means, again, the younger spouse is probably going to outlive the older spouse, consider doing some of this tax strategizing where the other spouse will pay a lot less in taxes on capital gains if they transfer the assets into one person's name. This is conversations that need to be not sugar-coated. They need to be upfront, black and white, have the conversation, make sure these things are being done so that you don't pay more in taxes and lose more of your own investment assets.
And we know that's what people will get when they give you a call as a call over at Foster Financial. Yep. Thanks so much, Heather.
Always good to be here.
Always good to have you. Everyone, take a look at your screen right now. Find out much more information. Heather just gave you a phenomenal wealth of information. Go ahead and give them a call if you say, hey, this is something I need to look into, or I know someone who may need some more information. You see that information on your screen. We'll be right back.